Hello and welcome to the last recording of the year. Warren, can you believe it? It's again December. It's the end of another year. And what I want us to start with the discussion is, let's take a 5-year view. This has been an incredibly challenging 5 years. Take us through that.
Yeah, I must say 2023 is the longest decade I've had in memory. And I think, just reflecting a little bit, I've been doing this for more than 27 years. And I think it's one of the hardest years I've ever experienced in my career. And I'm trying to understand why, because it's not as if we haven't seen stock markets do worse. We've seen stock markets do much worse. 2008 was a much bigger drop. But I think it's an accumulation effect where we are now. And we are getting clients coming to us and saying, gee, we talk about 5, 7, 10-year timeframes for judging investments. We're through 5 years, and over 5 years, investments are up, but they're not up a lot. We know what's going on. And so it kind of forces us to, which is a good thing, to look back and say, well, what's really happened over the last 5 years? And just for people watching, when we look at an investment performance over 5 years, that's not great. We start with, on the understanding, we can choose anything, anywhere. So we can choose, unit trusts in America, in China. We can choose, I hope we never do, but we could even choose Bitcoin if we really felt that there was a pressing need for that. But gold, silver, anything. So when we look at an investment that hasn't done well, or a portfolio of investments that haven't done well, it's important to understand we're looking at it and we're saying, firstly, let's measure it against a context. So if it's a ship and we're in the tide and the tide's gone out and the ship's gone down, it's not that the ship is sinking, the tide's gone down. And if the ship is rising and the tide's coming in, we can understand why the ship is going up. So it's exactly the same principle with investments. We need to look back and say, let's judge the investment performance against its context. Now I go back and we go, well, what's happened over the last 5 years? And it's a little bit, right? We've had a pandemic, and in our living memory, that's completely new for investment markets. It's not new for investment markets in history, but surely for almost 100 years, very new. And I think to give the pandemic a context, that was a massive stock market event worldwide. In South Africa, global, we saw markets tank in that time. What happened, though, was markets recovered very quickly, and that was very surprising. I think markets overcorrected, so they dropped a lot, but then they boomed. Why did they boom? Well, there were a few tech shares that really did well out of this whole coming out of COVID, moving into the digital world, and that was a big event, and we probably don't realize what an impact it actually had on markets and investors. And then, we kind of stabilized for a little bit. And then all of a sudden we had this thing called inflation. And in the beginning we had the American Fed saying, no, it's transitory. We had to learn a new word, right? And then we have interest rates going from 0.5% a year to 5.5% a year. And that doesn't sound a lot to a South African, 5.5% a year. We would love to pay our mortgages at 5.5, but it's 10 times what you were paying on your mortgage in a period of 2 years. So if you were paying $5,000 a month, suddenly you could be paying $50,000 a month. That's a massive jump. It's a huge stock market event. It has a much bigger impact on stock markets, for example, than a change in commodity prices or a bit of expectation. It's an enormous event. So I think understanding that it impacted share prices, it impacted property prices, it impacted bond prices. It was really a huge thing. And then, one of the things you and I have spoken about on this and many other updates is diversification is a good thing. Buy lots of different investments on the theory that some will go up when others are going down. And that's great. It works 97 out of 100 times. 2022 didn't work so well. What happens 2022, we see a balanced portfolio overseas losing probably around 18 to 22% in dollars. I think it's happened before, but it's only happened 3 times before. It's a huge amount that's gone on over the last 5 years. So then we get to the start of 2023. It's the decade of 2023 is how it feels to us. Things were okay to start. We were going. Everything was just going sort of okay.
Specifically, the first 3 odd months.
Yeah,
it was going nicely.
And we were kind of sitting back going, okay, markets recover after a big downturn. We can breathe now. And then a lot happened. Interest rates carried on going up. Inflation wasn't dying as quickly as especially the Americans thought it should. And then we had the Palestine-Israel conflict just to kind of really put a hammer into, and it's a massive humanitarian event, no question. It's also a stock market event, which it wasn't. The Ukraine invasion wasn't really a stock market event. This is a stock market event. So we get to the end of October. October was a horrific month, a really bad month. They talk about Black October. This was a Black October. And so it's been a really long time of things just going up, but mostly down. And so when you get to the end of a 5-year period and things haven't gone well, your investment portfolio's slightly up, understand the context, it's been really hard. Fortunately, the November looks okay. We're recording this with a couple of days of November to go, and been a very nice bounce. And I think sentiment is kind of working things out. Stock markets have bounced, currency markets are doing a little bit better. But that's not to say that this is what carries on for December and January. We don't know. But what we know is the last 5 years, an enormous amount has happened. Almost 2 decades worth of events have happened in a 5-year period.
And if you just look at the last few months, it shows this uncertainty of adapting to higher interest rates, adapting to higher inflation, and where does growth fit into that picture. And that's why I think the volatility you see, let's say October, and the volatility up in November shows you this uncertainty. And we also have to realize that we're moving in South Africa slowly into the election season. So we need to be very careful. Politicians will make predictions that are completely irrelevant. That's not true. They'll make promises to voters that is simply not going to happen. And I think we need to be cognizant of this. The early in the year, we're going to move into this electioneering phase. And unfortunately, that creates uncertainty for South Africans. Later in the year, we have sometime in the middle of the year, UK election, and then in November next year, an American election. So elections will play a role. But that is secondary to this whole adjustment, and you talk about 5%, the permanent adjustment of higher interest rates for longer. Yes, we might be closer to the top end of interest rates, we might be closer to the top end of inflation, but it is going to be a process. And usually when we see interest rates start to come down, you see strong movements into equities, bond markets start to move, and then you also see emerging markets start to come to the fore. So we might be closer to that kind of shift. You have to realize that the South African equity market is at multi-decade lows if you look at the price-earnings ratio. It's been here before, but it's only a few times in the last 2 decades or so. Capital markets, real interest rates, again, are at multi-decade highs. It's been here before a few times, but we're in that realm of great value, but that doesn't mean things are going to go up. Your view on the next year?
Well, I think valuations always count. So when you say, the capital markets, we're talking about bonds, and we're saying interest rates are very high. And what we know about interest rates is they have the inverse relationship to prices. So if interest rates are really high on bond markets, that means they don't generally go and double up from there. It's more likely that they go down. As they go down, that's great for the price of bonds. It's great for the price of property businesses worldwide. It's great for the stock market. So what we know is interest rates, if they're not at the peak, they're very close. We don't know when they come down, but what we know is the market's going to look forward. So it's going to look at this stuff and say, when the market starts to realize on a sustained basis that they've got inflation under control, that they can start to anticipate rates dropping, even a 0.25% drop in the US will be very significant for
investors. It's the signal.
Yeah, exactly. And I think, so to answer your question, I think globally we're looking at the end of the inflation story, whether we're there or not. I mean, we don't know. We're good at not predicting. So
we're closer to the end than the beginning. I think that we can say with confidence.
We're definitely past beginning. We're hopefully near the end. So I would say that interest rates are such an enormous factor that will be very positive for markets. And I think people watching are going to say, yeah, but you're positive on emerging markets. We are, and because of that, it will be good for the rand and it will be good for the JSE, not because of economic factors in South Africa, but because of this global flood that takes money away when rates are rising and brings money back when rates are falling. So I'm expecting that we get somewhere along the line good news on inflation and interest rates worldwide. That'll be positive for South South Africa. Is it the first half of the year or the second? We don't know. But that's one big thing.
If you look back, Warren, I'm going to close with this if you look at the last 5 years, having noted last year, obviously you started with saying we've got the choice to invest in any instruments, any markets in the world. Is there major changes that you foresee in our house view?
I think the answer is no in terms of the house view, but I think to explain what's happening. So we always try and get that balance between an index and an active manager. Now, the active managers for the last 5 years haven't really covered themselves in glory because actually low interest rates have been very good for the index. It's just shot ahead. The likelihood, as you said, that we live with higher interest rates mean that not every business will do well. And that's where the stock pickers might kick in now. So this view that we have of being spread in assets and markets and styles, we think that might be a big factor. So no, we don't want to change the portfolios dramatically. There might be some tweaks along the way, but I do think we'll see different engines of growth. You know, people must be careful of saying it's always the American story. You know, the next decade might be the Japanese decade, and might be the Indian decade, might not be America and China, and we'll be spread across those as well to take advantage of those things. And then I think we need to talk a little bit about South Africa, Theo, and what's going on here.
Look, unfortunately, I think there's been the news that we are seeing from specifically on the political side is not great. We're living in load shedding. We have this massive problems with other state-owned entities. I see there's more and more news about not only about Transnet and about the harbours, but the post office. So from that point of view, it is not great news. I do, however, believe that we will have an election, probably in April or May. We don't have a date yet. But the point is, I think we're moving towards a side where, if you look carefully at the medium-term budget framework of the Minister of Finance, there's one thing that stood out for me in that whole budget, was the fact that he noted specifically what they've learned from Eskom is if there's a power problem with Eskom, don't try to fix Eskom, fix the whole sector. Eskom only becomes a player in that sector. And I think that's where we're starting to see the solution. It will not be Eskom. Yes, Eskom need to be in a much better situation, but you look at the sector and you try to broaden the capital and the participants in that sector. Now that message is being taken to the Transnet and to the Ports Authority, but that's where South Africa's solution will lie. Not by trying to fix the SOE. I think some of those SOE's models are just not fixable. They've been managed badly, maintenance has been badly. So rather look at the whole sector and say, where can the private sector come in to assist government in fixing that? And I think we're going to see that multiplying. There was a great study last week published by Harvard University, Professor Richard Hausman, that specifically noted where South Africa's problems lie. And one of the elements that comes out of that is that the closer you get to where an election can change the government, the more serious the government is to fix the problems. And I hope that we're moving into that direction. The orange light is and will still remain, be careful for the headlines until the election. Those headlines, people are not talking to the markets, they're not talking to investors, they're trying to mobilize people to vote for them. So be very careful what you read and be very careful how you interpret that.
I mean, I think a great example of that is the Argentinian election, where you have this absolute radical promising to shut down the Reserve Bank, dollarize his economy, all of that stuff, gets into power, and he starts backtracking on a lot of those things. And it was scary what he wanted to do, and what he now wants to do might be a lot more sensible. So it's electioneering.
And we need to be careful of that. We're going to see all of that publicity coming through.
And I think also we need to talk about, by the end of 2024, the power situation I think will be much better.
Yeah.
Not because Eskom's much better, but because private power will be kicking in a lot more then. And I think that will be very positive for all of us.
If you just look at those, and there's various scenarios, but if you look at what's coming online, we are moving towards a better situation. Unfortunately, it's going to take time, but we are slowly making progress towards that. I agree with you.
And I think if we do see that sort of, I don't know what they want to call it, but let's just say semi-privatization of the Durban port, that Terminal 2, that actually goes ahead, I think, again, it's another very strong signal and a very big move.
And one needs to remember, markets look forward. Markets are not going to look at what's happening in the year. They look at what's happening the year after or the year after. And that's what we need to be cognizant of.
So I think maybe our summary is it's going to be another interesting year. And we don't know exactly where things are going to go. We hope, with interest rates being a very predictable factor, not the timing of the interest rate, but falling interest rates, extremely predictable, that it will do very well for markets, and that's what we're really looking for globally, and that will be positive for investors with local and global assets.
Underlying to that is our local assets are priced almost for disaster. So there is the opportunity of repricing there. Well, Warren, it was another interesting year. It was a great year. It was a difficult year, and enjoy your break, and I hope everybody is safe and enjoy your family time. And make sure that you do not focus on the day-to-day news. That's not going to help you. And hopefully next year will be a much more easier year, much more predictable, and we won't have these surprises. But then again, we can't predict.
We will have surprises. That's the only thing we know. It will be surprising. And to say to our clients as well, don't worry, we're worrying for you.
That's why we don't sleep at night.
All the best for 2024.